Much again, Alain. Let me see if I can get the video working here.
I can see you clearly on the screen, Michael, and I like your hat.
Like my hat?
Yes.
Well, there's a story behind this hat, but we'll get to that later. Anyway, ladies and gentlemen, welcome on this rather dreary day. We're going to talk today about one decision investment portfolios, and particularly something that may be used as a core holding, and we'll define that a little bit later for your overall portfolio. Alain has already gone over this, but just to mention our standard disclaimer that nothing in this presentation should be considered as personal advice. The author has no opinion as to the future direction of stock or any other markets, and frankly, the more things go on, the less idea I have of what's going to happen anyway. Reminding people that all investing involves risk and that readers should seek the advice of a registered financial or investment advisor, an advisor with an E, or conduct their own due diligence before making any investment decisions. I want to acknowledge once again the National Association of Federal Retirees Ottawa Branch, Linda Barber, our Executive Director, Sarah Campbell, who is our intern who's putting all these webinars together, Michael Patinode from the Ottawa Share Club, who again has provided, as you will see, some excellent graphs, Frank Schilder, who is the Zoom master hidden behind the controls that keeps us all going straight, and Alain Corriveau, who is the member of the board of directors and the chair of the member and services committee, and who's acting as host for this event. So we're going to start off this time right away with a poll question, because I want to hear a little bit about what your interests are in the way and why you invest. So take a few seconds to answer this question. I'm investing mainly to earn income, to provide for a better retirement, provide an inheritance for my family, give to a charity, or all of the above more or less equally. So we'll take another 10, 15 seconds, give you a chance to answer. Okay, well, 60% of you, as you can see, are primarily interested in earning income to provide for a better retirement. And that's good to know, because really that's going to be the focus of this presentation today. It's also interesting that a certain percentage are looking forward to providing an inheritance in the future. And some are looking at sort of everything more or less equally. So I want to start off talking a little bit about the benefits of exchange traded funds. And a seminar or two ago, I was talking about ETFs, and then at the end of it, somebody asked a question, well, what's an ETF? So let me address that, because I know that people still are having problems getting their head around what is an ETF, or an exchange traded fund. And basically what it is a mutual fund that you're used to, but instead of getting it through your bank or through an advisor, you can buy these things basically like a stock. So they're bought and sold like a stock through a broker, including through discount brokers. And ETFs have a couple of major advantages. First of all, they tend to be much lower cost than a managed mutual fund. And one of the reasons is that because of the way they're bought and sold, there are no trailing commissions paid to whoever sold you the fund. Unlike almost all managed mutual funds, where there's a trailing commission paid to the person who sold you the fund, typically in the order of 1% or more. So Typically, an exchange traded fund costs 1/5 to 1/2 of what an equivalent managed mutual fund might cost. They have the same sort of diversification. You can buy ETFs today. I think there's over 600 in Canada. You can buy an ETF that gives you the entire Canadian stock market, the entire American stock market. And as you can see, as we go through this, the whole point of this presentation is that you can buy ETFs, which do everything for you. Well, almost everything. The other thing that I'm going to show you is that most index ETFs beat managed mutual funds in terms of performance, and they do it consistently. And you will be surprised at the numbers. And last point is that these all-in-one ETFs that we're going to talk about today are really designed for self-directed investors, for people who want to essentially fire their advisor with an O. And we'll talk about the difference of that too. So here's a chart that shows the performance of Canadian actively managed mutual funds compared to their indexes. And this information is to the end of 2019. SPIVA, which stands for Standard & Poor's Index versus Active. SPIVA just came out with their new report to the end of June 2020. I didn't have a chance to update it. You can look it up yourself, just Google SPIVA Canada, but the numbers haven't changed much. So this is the percent of actively managed mutual funds, Canada-based, that beat their respective index. So if you look at Canadian equity, you can see that over a 10-year period, 14% beat. That means that if you are buying a Canadian equity mutual fund, your chances of beating the index is about 1 in 7. If you look at US equity funds, 3%. So your chances of beating the index are 1 in 33. Canadian dividend, 4%. International equity, 2%. And these numbers don't lie, folks. These are the way things have returned. And so the main reason why this occurs is because the funds, the managed mutual funds, the expense fees are too high. Typically in Canada, 2% or more, compared with an index tracking exchange traded fund that might have an ETF of 0.05. The other thing I wanted just to mention to you, and this is something that I find really bothersome, but right now in Ontario, legally, there's no difference between an advisor with an O and an advisor with an E legally, except that an advisor with an O has no legal responsibility to the client. Anyone in Ontario right now can call themselves an investment or financial advisor. But there are advisors with an E who are what are called CFPs, Certified Financial Planners. And they have to have passed a very robust course that often takes 2 to 3 years to get through. And they actually have a fiduciary responsibility. That means a legal responsibility, similar to a lawyer or a doctor, to do what is in the client's best interest. But to repeat, an advisor with an O has no legal responsibility, has no registration, and frankly, may not have much more training than a 1-month bank course on how to sell mutual funds. Most advisors are fee-based, ranging from 0.75 to 1.5% per year, depending on the portfolio size. Some will even do things on an hourly basis to develop a plan for you that you can then implement yourself using a do-it-yourself online investing account. And again, as I mentioned, an advisor with an E must have formal training and certification. Now, this is going to change. Legislation was passed in Ontario last year, and they are going through the process now of trying to define exactly who can legally call themselves a financial advisor. But the regulation is not yet in place. By the way, this is not the case in Quebec. In Quebec, it is very clear who can legally call themselves a financial planner, and it's set out in legislation in Quebec, but not in Ontario and not in most of the rest of Canada. So poll question number 2. I mainly do my investing through my bank branch advisor with an O, a commission-based broker, a fee-based advisor, an independent fee-based advisor, or a do-it-yourself online brokerage. Please take a minute. Okay, well, I think everyone's voted. So 34% of you are using a do-it-yourself online brokerage, which I think is terrific. And I think that this webinar today will be specifically of interest to you. 18% are dealing with a bank branch advisor. The issue there, to repeat, is that these folks are only licensed to sell mutual funds. And typically, they only sell the mutual funds that are sold and produced by their bank. A commission-based broker can sell anything. The issue with a commission-based broker is that they do not have a fiduciary responsibility to do what's best for you. And there's the potential, not always, but there's the potential for conflict of interest. For example, I remember some years ago, I had a mutual fund that I thought was doing very well. And for years it did. And then it stopped doing well. And I took a look at it, and I didn't know much about these things at the time. I discovered that it had a management expense ratio of 2.5%. And one of the reasons was that they were paying over 1.25% to the person who had sold me the mutual fund. So their fees were very high. It got to be a huge fund, way too big. And it was because, frankly, they were paying such huge fees to the people who were selling the funds. 29% of you are with a fee-based advisor with a national firm, 6% with an independent fee-based advisor. So that's good. Anyway, interesting to see how it's broken down. I want to show you a couple of things as we get into it here. Let me just double check. The one thing I wanted to show you was how bonds operate. And this is something that I think a lot of people, again, have a little bit of trouble getting their head around. Now, everybody knows that we're into a situation where we have very low interest rates, low rates on bonds. So a lot of people are saying, well, why would you own a bond if, for example, a 30-year bond is paying, 1.5, 1.6%? But what this chart shows you is the difference between the interest rate, which is the gold line, and the price or value of the bond, which is the blue line. And what you can see is that as the interest rate declines, the value of the bond goes up. And it's simply a mathematical calculation, but basically as interest rates decline, bond values go up. So in a portfolio, you can have a situation where your capital value of the portfolio goes up if you've got bonds in it, even though interest rates decline. Interest rates decline in recessions. And so stocks tend to decline in recessions. So by having some bonds in your portfolio, even if a recession hits and interest rates decline, you can still get a capital gain through your bonds. So here's an example. You take a typical 30-year US government bond. The current interest rate today is about 1.5%. If the rate drops to 1%, which is not a huge decrease, that's only a 0.5% decrease, that bond increases in value by 13%. If you want to prove it to yourself, you can go online, find by Google a bond value calculator and try it yourself and you'll see. So, we don't know what interest rates are going to do, but if things worsen economically and interest rates decline, they only have to decline by 0.5% to generate a 13% increase in the value of that bond. So let's talk about these all-in-one or one decision ETFs. Basically, they're one decision investments that require limited investing know-how. They're professionally managed. In other words, some very well-educated professionals decide what is going to be the mix of the various assets going into these things, and I'll show you in a minute. They're automatically rebalanced, so you don't have to worry about any of that. There's multiple asset allocation choices. I'm going to show you the Vanguard selection, which offers 5 different asset allocation choices. They're low cost. And once they're bought, set up, there's basically nothing else to do. And I remember reading somewhere that a well-known investor said that good investing is like watching paint dry. You should basically have to do nothing. And these certainly meet that requirement. So here are the 3 most popular from the Vanguard family. And I'm only using Vanguard for 2 reasons. 1, they were the first to introduce these things in Canada. And 2, they've got the best graphics. But there are other companies who provide these, and frankly, they're all good. So one of the first things to note is that the MER, the management expense ratio on these, are about 0.25. Now remember I said a typical actively managed mutual fund is about 2%. So these are roughly 1/8 the cost. And over time, that adds up. And you can see that the way they build these is that they use 7 underlying ETFs down here, that everything from US equity, Canadian equity, the developed world except North America, emerging markets, Canadian fixed income, which is bonds, global except the United States fixed income, and US fixed income. And these are their 3 most popular blends. So VCNS is a conservative portfolio. It's 40% equities, 60% bonds. VBAL is 60% equities, 40% bonds. And I can't even read here, VCGT is the growth portfolio. It's 80% equities and 20% bonds. And so you can think what fits your own needs best. You can consult with a fee-based advisor and determine what works for you. They've also come up with a couple more. I think these are less likely to be of interest to people. The VCIP is only 20% equities, and you can see the breakdown. And then the all equity portfolio is 100% equities. Again, I think that most of us are probably interested in the previous 3. So poll question number 3, I have ETFs in my portfolio. Yes, no, or I need more info. Okay, so about 55% of you are saying yes, 22% saying no, and 24% are still waiting to get to the end of this webinar today. So this chart, and I apologize for its fuzziness. I don't know why it's so fuzzy. Maybe it's just too early in the morning, or maybe there's too much rain on the wires. But this shows you the performance over the last year and a half of three of these balanced ETFs. So this is one from Vanguard, one from iShares, and one from BMO. And you can see that there isn't much to choose between. They use different mixes, different blends in their formula, and that affects what the overall outcome is. But it's not really material. And so I think any of these families of these all-in-one ETFs are fine. There's another company called Horizons, which also produces one, and more companies are coming up with them every day because they become immensely popular. There's more than $2 billion invested in these already, and they've only been on the market for about a year and a half. Here's just to give you some comparisons of how these balanced all-in-ones compared with different indexes. And these are total return indexes. So that means it shows you the capital gain plus the dividend. So you can see that since about mid 2018, the Vanguard Balanced portfolio has done considerably better than the S&P ETF, which is called XIC. And again, recall that these are total returns. So that's VBAL 60/40 compared to the TSX. VUN is the US total stock market in Canadian dollars. And you can see that the gold line, outperformed the VBAL significantly. The point here is that VBAL contains a certain amount of US stocks, so you would have benefited from the rise in the US stocks through owning a balanced ETF. And remember, when we looked at the TSX, it was down here significantly below VBAL. VBAL versus ZLT. ZLT is the US long-term treasury bond market. And again, you can see that it significantly outperformed. But again, because VBAL's got about 40% bonds in it, it benefited from the higher returns of the bond market, particularly over the past year and a half. And finally, VBAL versus RBO. RBO is a corporate bond ETF, shorter term. And you can see that, well, it was pretty flat. That again, VBAL outperformed it because it had exposure to the wider version of bonds available through its overall portfolio. But the important thing is to remember that all of these different components are included in something like VBAL. You don't have to figure it out, it's figured out for you. Now, recently, Vanguard came out with its latest all-in-one, and it's called VRIF. And they call it the Vanguard Retirement Income ETF. And the way it works is that it aims to deliver 4% per year in income. The MER again is about 0.25. And this is a good core solution for people who want to have a more or less almost guaranteed source of income. Now, nothing is completely guaranteed, but this is their goal. And again, you can see here how it's made up of these different underlying ETFs. And this is all done for you automatically. You don't have to worry about it. One click, one buy, you get VRIF and you get 4% per year. Now, something that I think we have to put out as a caveat is that past performance is not indicative of future returns. And a lot of people, a lot of the pundits are beginning to feel that the classic 60-40 bond portfolio or stock bond portfolio is largely a relic of the past, and that alternative investments are going to become a bigger portion of portfolios. And so, for example, if we're talking about VRIF, 4%, that's great, but I know what you're thinking. You're thinking, well, Michael, my minimum mandatory withdrawal for my RIF is over 5%. So 4% ain't going to cut it. And that's why we think of these all-in-ones as perhaps a core holding to which you add other higher yielding investments. So for example, dividend paying stocks, which we're going to talk about in the November 12th webinar, gold, which we talked about on September 23rd, preferreds, which again we talked about on October 7th, infrastructure, which we're going to talk about on November 12th, and REITs, real estate investment trusts. Now, going back dividends, good dividend ETF today is yielding in the 5% range. Gold is there as a portfolio insurance for capital gain, not income. Preferred ETFs are currently yielding in the 5.5% range. Infrastructure, certain large infrastructure investments are yielding anywhere from 4.5% to 8% today. And REITs, real estate investment trust ETFs, are currently yielding 5+%. So the idea, and we'll get into this on November 12th when we talk about how to build the right asset allocation strategy, is you can use something like these all-in-ones, balanced ETFs as a core holding, and then build on top of them to increase your income. The other thing I want to mention, and I've used this chart before, many of you have already seen it, history doesn't repeat itself, but it often rhymes, which is the famous saying from Mark Twain. And we've gotten used to being told that equities, stock markets are good investments. They go up in value. Long term, you're going to make 9% on the US stock market. And that's true. But the definition of long term, when you're seniors, we may not be all that interested in long term. And I just want to reiterate to you, if you look at this yellow line, back in early 2000, this is where the S&P 500 was at. It got back to that level in about 2007, I think October 2007, and it dipped down again. It didn't get back to that level until 2013. So if you had invested back here at the peak in early 2000, you were at exactly the same place 13 years later, having made only the 2% dividend that is in the S&P stock market. So while it's true that stocks over the long term do yield 9%, there can also be long periods of time that they don't go much anywhere at all. And if you look where we are right now, up here, you can see that there are some similarities to back here in 2000, which was the dot-com boom that you might remember. And then the market went down almost 45%. Then back up in 2000, down 45% during the financial crisis. And then you can see that things have been climbing ever since. So remember, history doesn't necessarily repeat, but it often rhymes, meaning you can find similar things happening. So in conclusion, it's almost impossible to beat the markets. I know, I've tried. It's very, very difficult. Even top investors like Warren Buffett have trouble beating the S&P 500 today. Diversification is the key to long-term success, and that's been shown by research. In fact, It's been shown by research that 80% of investment returns relate to the asset allocation choices. Low fees are a major factor in returns. Balanced ETFs make it possible for do-it-yourself investors to have a professionally managed portfolio for a fraction of the cost. A balanced all-in-one ETF may be a good core holding, and by core I mean 30 to 50%. And the last thing I wanted to mention is that it's the total portfolio return that matters, not individual investments. We often look at our portfolio, one part of it's not doing well, we want to get rid of it, but we have to remember that these things are there to offset other things. And that even though something may not be doing well for a while, it's playing a role in the total portfolio. And that's what we should look at. What's our total return, and is it competitive? I want to remind people again, November 12th, the next webinar, matching your asset allocation strategy to your needs. And there I'm going to develop 3 model portfolios for you, including a pre-RIF, a RIF retirement model, and one for snowbirds, assuming that we're ever able to be snowbirds again. And then on November 25th, how to choose a financial advisor, and talk about specifically advisors with an E.